Ben Bernanke, Firefighting, the Financial Crisis and Its Lessons. Embark on a journey through the tumultuous events of the 2008 financial crisis with the Firefighting, the Financial Crisis and Its Lessons. Explore the disruptive intersection of the U.S. housing market, risky mortgage debt, and financial institutions that contributed to this disaster. Discover how lax underwriting standards, an inflated perception of home values, and outdated regulation paved the way for a financial meltdown. This summary will guide you through the complexity of these factors, expose the lack of oversight in the financial system, and ultimately help you understand the essential lessons learned from this modern economic catastrophe.
The 2008 financial crisis. In 2008, the U.S. housing market plummeted, and unemployment rose when a buildup of risky mortgage debt fueled a catastrophic financial disaster that had been building up over several years. Dubious mortgages, including ninja loans, liar loans, and exploding arms, were sold due to lax underwriting standards and rampant securitization. Companies like Countrywide Financial embraced the new model of risky lending, where they sold mortgages to investors instead of keeping them. The lesson learned was that soaring home prices could not stay high forever. The crisis was fueled by risky leverage, runnable funding, shadow banking, rampant securitization, and outdated regulation. The 2008 financial crisis. In 2007, Timothy Geithner expressed confidence in the stability of the mortgage market, but Wall Street bankers invested heavily in real estate. The first red flag appeared when French bank BNP Paribas announced it would no longer honor withdrawals from funds holding subprime mortgages backed by U.S. homes. This declaration triggered panic, leading up to the 2008 financial crisis, which destroyed the livelihoods of many. The financial crisis spark. Subprime mortgages with adjustable rates were the main cause of the 2008 financial collapse that spread throughout the financial system. The losses could have been prevented as those types of loans accounted for just 1 in 12 mortgages in the U.S. housing market. Irresponsible lending practices in America's subprime mortgage sector triggered the crisis, but the absence of crises over the years, leading to a period of financial stability, also played a role. As the economist Hyman Minsky noted, extended periods of financial stability can create crises because investors become unconcerned about risk, setting the stage for a meltdown. Oversight calls for regulatory reform. The U.S. financial regulatory system faced complex challenges leading up to the 2008 financial crisis. Although banking regulators scrutinized banks, non-banks such as AIG, GE Capital, and GMAC were overlooked despite operating like banks without insured deposits. The regulatory bodies overseeing the banking sector, the Fed, the Office of the Comptroller of the Currency, the FDIC, and the Office of Thrift Supervision, lacked an integrated view of overall risk to the financial system. Moreover, in the years preceding the crisis, many saw regulation as an impediment to the financial system. Taming major financial panics. In the face of major financial crises, central bankers must act decisively to avert an economic catastrophe. While some firms may not deserve bailouts, timely intervention and slashing interest rates could be effective measures. The excessive optimism surrounding the housing market was the driving force behind the boom in mortgage borrowing. Bear Stearns' failure in March 2008 threatened a severe impact on the financial system, so the government engineered a rescue to save it from impending disaster. The rescue did calm the markets for 6 months. However, it also attracted criticism for bailing out greedy, irresponsible Wall Streeters. It's a tough call for central bankers to recognize the impending danger and be willing to act in the face of political backlash. Financial market panic. The federal government bailed out Bear Stearns, but its management team and stockholders were not saved. In March 2008, J.P. Morgan absorbed Bear Stearns to prevent the market panic from happening. In July 2008, the FDIC took over IndyMac Bank of California, and the panic spread to Washington Mutual. Fearing the contagion would spread to Fannie Mae and Freddie Mac, the government injected an unlimited sum to rescue the mortgage companies. The government intervention was criticized for engaging in socialism. However, Bush supported the bailout, stating that it was necessary to save the economy. Ultimately, the Bear loan was repaid, bringing a $2.5 billion gain for taxpayers. The financial crisis unraveled. The 2008 financial crisis was catastrophic for the U.S. economy, with prominent firms such as Freddie Mac, Fannie Mae, AIG, Lehman Brothers, Washington Mutual, and Wachovia either collapsing, being taken over or saved by the government. While AIG was rescued, Lehman Brothers collapsed, leading to the biggest bankruptcy in American history. Despite badgering from Paulson and Geithner, Lehman's lack of solid collateral made it impossible to structure a loan backed by its assets. The government intervention faced criticism from the public and politicians for being a bailout. Ultimately, the government earned a $23 billion profit from the rescue of AIG. To broaden the financial rescue, Paulson pitched the infamous $700 billion TARP to Congress, which ended up getting initially rejected, causing the market to plunge by 9%. The TARP bill passed later. The crisis was chaotic and destructive, leaving a deep impact on the public and economy. The U.S. government's role in the economic meltdown. Despite mixed public feelings, Congress approved the government's increased involvement in the market during the economic meltdown. The bailouts continued from 2009 to 2012, and quantitative easing injected trillions into the U.S. economy. Both political sides faced fears regarding the rise of big government, with some supporting a Tea Party movement. Liberals blamed Washington for allowing Wall Street to profit with little oversight. While taxpayers initially felt they were paying the price for Wall Street's mistakes, they eventually earned profits from the bailouts. A post-2008 era of financial reforms and uncertainties. The 2008 financial crisis, also known as the Great Recession, prompted Congress to establish stronger regulations aimed at making financial markets safer. Despite the reforms requiring banks to take on more capital and liquidity while reducing leverage and short-term financing, political backlash had undermined some of the reforms and complicating future bailouts. Moreover, the current polarized political atmosphere makes it hard to think ahead. Even though big financial institutions may have rescued smaller entities, some criticism suggested the Congress had failed to break up the too-big-to-fail banks. However, Bernanke, Geithner, and Paulson's aggressive attempt at financial firefighting proved to not be enough. While these efforts may have sparked crucial changes, the possibility of financial volatility remains due to failures of imagination and limitations of memory inevitably. Furthermore, persistently low interest rates are another wild card, as the Federal Reserve no longer holds the leeway to cut rates to stimulate the economy.
As we reach the end of the gripping tale of the 2008 financial crisis, it is vital to recognize that while the period of panic and meltdown has passed, more crises may await us in the future. While stronger regulations and the necessary lessons have been learned, we must remain vigilant and proactive, as complacency and lack of oversight can lead to disastrous consequences. The growing divide in the political landscape may hinder the capacity to respond to another financial crisis. Therefore, understanding the lessons of the past should serve as a compass for navigating the uncertain landscape of the financial world and mitigating the risks that lay ahead.